Yeah, I think generally our view has been pre the election outcome that inflation will come down further, core inflation in particular, and you have good growth, and that creates a friendly backdrop. It's getting a bit less friendly compared to the last 2 years where inflation came from very high levels and growth surprised quite a bit to the upside. But it was still a friendly backdrop, which had a bit of a Goldilocks flavor. No, lower inflation, good growth. But I think now with the US election outcome, you shift much more towards reflation. And reflation is a different type of regime where I think Goldilocks tends to anchor volatility. It's very good for carry. It's good for the Magnificent Seven, which are a bit like a carry trade, high Sharpe ratios. Whereas now with the reflation, you're starting to see faster moves in equities higher for now, but at some point possibly also faster moves in bond yields. And that can then spill over back to equities and actually create a bit more volatility, lower Sharpe ratio. It doesn't have to mean lower returns, but the problem is also valuations. So in the end, coupled with the valuations and the reflation, we expect lower returns.
That's interesting as you talk about the correlation that we've seen in equities and yields both moving higher. If you just chart, say, the Dow for this year, you can see how strong the bump up has been from the end of last month into this month on the election trade. What does that mean even into year end? Because typically we have the Santa Claus rally, we all start talking about it. At this point, it turns up at some stage. Has that all been disrupted by the election?
Well, it might have been pulled forward a bit. Yes. Santa come early, you could say. I think generally the problem is always level, speed and source of bond yield increases. I think let's start with the source. The source has actually been growth and optimism on nominal growth, deregulation, taxation. These are good things, and that's why equities can deal with the higher bond yields. The speed has been a bit too fast. Normally, when there is over a 3-month horizon, a more than 2 standard deviation increase, that usually drives indigestion. We're getting there. 4.6, 4.7 is the level we're watching on the US 10-year yield. And the last thing is the kind of source. And I think the level of the source is the real yield in particular. So we're watching in particular if real yields are pushing up, and if they're pushing up towards 2, 2.5, that's usually the level where equities have indigestion. So it could get a bit more bumpy, and we've seen that already in the last few days. I think.